Hey, and welcome to Rags to Riches. Before we start off today's video, I want you to answer this seemingly simple question. Which stock has the ticker T? Now, if you said AT&T, you are correct, but what if I told you you were actually also wrong? T actually belongs to AT&T on the New York Stock Exchange and Telus on the TSX, or the Toronto Stock Exchange. Now, if you never heard of Telus or AT&T, that's okay, as Telus is a Canadian company and AT&T is mainly in the America. We're going to do a quick breakdown of each and discuss why each company may be an attractive buy for an investor today. So, first off, AT&T. AT&T mainly covers the United States, but also has some coverage in Latin America. With a market cap of $135 billion, a PE of 7.85, and earnings per share of 2.42, currently down just under 1% over the last year, yielding an attractive 5.68%. AT&T is sitting at just $19.02, meaning for every share of AT&T you buy today, they will pay you $1.11 in dividend income every year. AT&T has been paying their dividend for 39 consecutive years with a 10-year dividend growth rate of 1.92. However, this does include the dividend cut. So we're going to look here at a graph of the dividends over the past many years that they've been paying. With the recent spinoff of Warner Bros. Media segment, AT&T is decided to grow their telecom business and just focus on that. With over 200 million mobile subscribers, AT&T reported strong subscriber growth, continuing driving revenue growth. Analysts are projecting growth estimates of negative 4.46% over the next 5 years. So you can see the cut in the dividends there and quite substantially compared to what it was before. So the ratings up at the top, those are from Seeking Alpha. The analysts give it a growth rate of F and a total valuation grade of A, meaning it's a good buy, but it doesn't really provide much growth. Now, we're going to move over to Telus, which trades on the Toronto Stock Exchange under the ticker T as well. Telus, which trades on the Toronto Stock Exchange under the ticker T or TU on the New York Stock Exchange, is part of the telecom oligarchy in Canada. The oligarchy is mainly, there's only three main rivals in Canada. There's not many options up here. So Telus has two main rivals, Bell, which trades at a PE of 20.16, and Rogers, which trades at a PE of 19.87. Compared to Telus, which is a 19.11, Telus is representing the lowest PE ratio out of the big three, with a market cap of $39 billion and earnings per share of 1.46, currently down 8.9% over the last year, yielding 5.2%. Telus is sitting at just $27 Canadian or $20.11 US, meaning that for every share of Telus you buy today, they'll be paying you $1.40 Canadian or $1.04 US in dividends every year. Telus has been paying their dividend for 28 consecutive years with a 10-year dividend growth rate of 8.86. So something that's unique to Telus that a lot of telecoms don't have is Telus continues to advance their long-term growth strategies through technology-oriented growth engines, including Telus International, Telus Health, and Telus Agriculture. Analysts are projected growth rates and estimates of 18.43% over the next 5 years. You can see here, this is just some basic information from their website. You can see the dividend graph compared to AT&T's. You don't got that massive dividend cut. It's been growing pretty substantially over the last few years compared to AT&T, which was an F for its growth grade. Telus has been given a B-, which isn't too bad, and a valuation grade of a B. However, if you recall, both AT&T and Telus were both buys by Wall Street. We're going to look at a total price comparison now to get the whole story here. So both companies are looking like attractive buys this year, but as a Canadian, I've been using this time to buy more Telus. When compared compared to most other telecoms. And the main difference here is that they're having success in doing this. A lot of telecoms, they try venturing out and the flame gets snuffed out. Look at what happened to AT&T. Full disclosure, I do own 20.5 shares of Telus, which pays me a combined $28.90 of dividend income per year. I'm looking to add to that position shortly, seeing where the market goes. I also do believe that AT&T is a well-established company that I believe is still finding its way after the spinoff. And the future growth seems unclear. Although there are an attractive buying opportunity over the past few months where the stock bottomed out below $15 per share, I think it's still a decent buy today. So does Wall Street and so do the analysts. So I wouldn't really hold back on it. Dollar cost averaging it always works best. So you can see here that over the past 3 years, Telus has actually followed pretty just below the S&P, actually surpassing it at the start of 2022. And then shortly, once the telecom started to get hit, it's kind of, once you look at total returns, this is total returns. So that's the price plus the dividend. Telus is actually pretty close in total returns with the S&P 500, slightly less, but also 10% more at least, or more than 10% above AT&T. So that's something to consider when you're looking at the price. I think this is going to continue. Telus is having pretty good success diversifying and growing different revenue streams, unlike most telecoms, which grow kind of stagnant. So yeah, if you're looking for just a new idea, you might want to look into Telus. So thank you for watching, and this is just a quick video describing these two companies. Don't forget, like, comment, subscribe. Let me know what you think in the comment section below.